Welcome back to this session for CMA final students. This is your paper number 20, section B, business valuation. And now we are going to revise your study note number 7, that is valuation of assets and liabilities. In this chapter, we will talk about valuation of inventory, valuation of investments, valuation of bonds, valuation of equity shares, valuation of goodwill, valuation of human resources assets, valuation of brand of a company, valuation of economic value aided by the company, etc. So we'll be talking about various types of assets that for various purposes, how to make valuation of different types of assets and liabilities. And I'm your friend Tarun Mahajan, a chartered accountant, a chartered financial analyst from CFAI USA, and a registered valuer of securities or financial assets. That is, practically, I do practice valuation of equity shares, preference shares, complex debentures, and many other securities. So here in revision also, I'll try to give you some flavor, a little bit of flavor of the real life, but mostly we will focus on examination purpose because this is a quick revision. Let's start with valuation of inventory. So being a student of cost accountancy course, this is like a child's play for you. How to make valuation of inventory using first in first out method, last in first out method, and the weighted average method. Accounting standards in India, they do prefer that you should use either the first in first out method or you should use the weighted average method. And LIFO, we say, oh my god, LIFO, we don't want to use it. That remains in the last in our priority list. But if I talk about US GAAP, United States of America Generally Accepted Accounting Principles, they do prefer LIFO over FIFO. Because, practically there is one advantage of LIFO, that it is more conservative than the FIFO. Like under inflationary situation where the price of goods and services are rising day by day, month by month, year by year. Suppose my opening inventory was valued at 100 rupees. During this year, I keep on making purchase at 101, next month 103. Next month, my purchase price is 107 rupees. Next month, 108 rupees. Next month, 110 rupees. Now, my last purchase was at 110. If I'm using LIFO, last in, first out method, in that case, I will charge the latest purchase to the profit and loss account, and under inflationary conditions, latest purchase will be most expensive. So the most expensive purchase will be charged to the P&L account, will be charged to the cost sheet, and that way my profitability will remain in control, it will reduce. And the earlier purchase, the cheaper purchase will remain in stock and it will be shown in the asset side of the balance sheet. So that's not fair value accounting, I'll say. That's a conservative accounting. So that is how they do prefer LIFO over FIFO or weighted average. Anyways, let's do this very simple question. It says that oil company is a bulk distributor of high octane petrol. A periodic inventory of petrol on hand is taken when the books are closed at the end of each month. Okay, so we are making valuation of inventory at month end. The following summary of information is available for the month of June 2016. Sales during the month is rupees 9,45,000. General administrative cost is rupees 25,000. I think these two information are going to be useless for us Because while making valuation of inventory, we are not interested in sale, we are interested in purchase price and purchase units or opening inventory. Opening stock. So currently this seems to be not useful. If needed, I will consider it. Opening stock is 1 lakh liters at the rate of rupees 3 per liter. So it's valued at 3 lakh rupees. Purchase including freight on June 1st. 2 lakh liters were purchased at 2.85 per liter. Then on June 30th, again 1 lakh liters were purchased at 3.03 rupees per liter. So I should write it like this. And closing stock on June 30th is 1,30,000 liters. Okay, so opening stock was 1 lakh, purchase was 3 lakh, total was 4 lakh, and out of 4 lakh, you are saying 1,30,000 is in stock. It means 2,70,000 units are sold. Fine, perfect. Compute the following data by FIFO, weighted average, and LIFO methods of inventory costing on June 30th. It's a very simple question. So let's make a statement showing value of closing stock or value of inventory as on 30th June 2016 under FIFO, weighted average, and LIFO methods of pricing. Look here, if I'm following FIFO, then this 1,30,000 unit is the latest purchase. So 1 lakh unit should be valued at 3.03 and remaining 30,000 units should be valued at 2.85. So look here, 1 lakh liters at 3.03 is 3,03,000 and 30,000 liters at 2.85 is 85,500 rupees. So under FIFO, look here, this is FIFO column. The value of inventory appears to be 3,88,500 rupees. Great. Then let's talk about the weighted average method. So this is the weighted average method. Now here I need to calculate weighted average of opening stock and purchase. So weighted average of 3 rupees, 2.85 rupees and 3.03 rupees. Weighted average of 3 rupees, 2.85 and 3.03 when the weight assigned is 1 lakh, 2 lakh and 1 lakh. So here I calculate the weighted average like this. 1 lakh liters at 3 rupees opening stock, 2 lakh liters at 2.85 June 1st purchase, then 1 lakh unit at 3.03 June 30th purchase. Total of weights is 4 lakh and weighted average is 2.9325. Let me check. Is it 2.9? I think this is 2.9075. Let's cross check this. So this is simple. I'll say first of all, 3 lakh rupees I should take. Look here. 3 lakh rupees I'll keep in memory. And then 2 lakh into 2.85. That's 570. I'll keep it in plus memory. And then 1 lakh into 3.03. 3 lakh 3,000. Again in plus memory. So memory recall is 11 lakh 73,000. Yeah. Divided by 4 lakh units. 2.9325 it is. This is correct. 2.9325. And now 1,30,000 units are in stock. So multiply it by 1,30,000. 381,225. 2.9325. 381,225. These questions I have taken from your own study material, like this is illustration number 4 from your study material. But I have corrected the question as per the requirement. Sometimes there were error in the question or in the solution, so I corrected those errors in solution. And sometimes I have extended the question with my own numbers so that I can explain concept to you in a better manner. This is weighted average method, 3,81,225. If you are following LIFO, last in, first out, then the first 1 lakh unit should be in your stock at 3 lakh rupees. And 30,000 units should come from this purchase of 2.85. So look here, 1 lakh liters at 3 rupees per unit, it's 3 lakh under LIFO. And 30,000 units at 2.85, that is 85,500. 385,500. This is LIFO valuation. 381,225 is the weighted average valuation. And 388,500 is the FIFO valuation. Right? Easy question. Now let's check one more question on valuation of inventory. As per accounting standards, we usually make valuation of inventory at cost or realizable value, whichever is lower. Cost means your cost of purchase, including freight, etc. And realizable value means the sale price minus sale expenses. Whichever is lower is considered to be the value of inventory for the sake of accounting. This is again conservatism. This is not fair value accounting. This is conservatism, that you take inventory at lower of the cost or realizable value. The XYZ Machinery Limited requests you to ascertain the amount at which inventory should be included in the financial statements for the year 2015-16. Okay. The value of inventory as shown in the books of accounts is rupees 12,50,000. Fantastic. 12,50,000 is the amount of inventory shown in books of accounts. This is the current book value. I'm not saying this is cost. I'm not saying this is realizable value. I'm saying this is the book value. Because the book value may be either cost or it may be realizable value. To determine the net realizable value of the inventory as at 31st of March 2016, on a test check basis, you had selected several items whose book value was rupees 3,50,000. Okay. Now this is fantastic that you are making a test checking, and in this test checking, what you are doing is, I'll tell you, that book value of your inventory is 12,50,000. Out of which you have chosen a sample of 3,50,000. So what is not included in this sample is 9 lakh rupees. So this is part of your sample. So out of total book value, BV, that stands for book value. Out of total book value of 12,50,000, you have chosen a sample of 3,50,000. You had selected several items whose book value was 3,50,000. You ascertain that except for item A to C mentioned below, the cost was in excess of the realizable value by 29532, or you can say that realizable value is less than the cost. The difference is roughly 30,000 rupees. So out of 3,50,000 also, now there are some special items mentioned in A to C, and rest of the inventory is to be reduced by 29532. Apply this percentage downfall. Like I have made this correction in the question, it's not there in the original question. Apply this percentage downfall on inventory which is not included in sample. Okay. So now out of 3,50,000 also, it should be divided into two parts. One is item A to C. Item A to item C, which we need to take care separately. And remaining should be reduced by roughly 30,000 rupees. While reading the question, if you read it hurriedly, then your first impression about interpretation of the question will go wrong. And if your first impression for the question goes wrong, then even if you read the question thereafter for 5 times or 10 times, every time you will read it wrong and interpret it wrong. So I am giving you one very important, very simple exam tip, that while reading the question for the first time in the examination, devote proper time. Read each single word carefully and interpret it, because whatever mind you make after reading the question, then it is difficult to change your mind. If your first interpretation is wrong, then you go on with the wrong interpretation even if you read it second, third time. So this is how we have classified our inventory. Now the next thing. The following items require special treatment. Okay. These are ABC items. One machine, that is one inventory item, which is a cost of rupees 1,30,000, can now fetch rupees 1,15,000. So cost or realizable value, whichever is lower, this item A should be valued at 1,15,000. Okay, this item A should be valued at just a minute. Oh, this pen is disabled. Just a minute. I'll enable it. So I was saying that this item A should be valued at 1,15,000 rupees, right? Let me save this file first. Now look at this. So one machine cost rupees 1,30,000 can now fetch rupees 1,15,000. Cost or realizable value, whichever is less. Fine. So you should take it at 1,15,000. It was priced at rupees 70,000. Oh. So the book value at which it is included currently is not 130. The book value at which it is included currently is 70. So you can do one thing, that out of this 3,50,000, first of all, you need to deduct 70,000 rupees to arrive at the cost of remaining inventory. Out of sample, if you deduct ABC item, rest will be the book value of remaining inventory. So out of this 3,50,000, an item with book value of 70,000 has a cost of 130 and realizable value of 115. So cost and realizable value, whichever is lower. Therefore, I take realizable value 1,15,000. Now a pump which costs rupees 50,000. Okay, so second item is pump which cost rupees 50,000 was expected to realize rupees 35,000, a special commission of 15% would have to be paid to the broker. So 35,000 should be multiplied by 0.85 because 15% is commission. 29750, right? So this is plus 29750. Writing on a standing screen, then you see the bad handwriting thereafter. And there is no separate book value. So we are assuming that this item currently is included at a book value of 50,000 rupees, right? Now 6 units of product number 1570. This is not amount. This is the item code. 6 units of product number 15710 were in stock valued at rupees 5520 each. Okay. So 5520 into 6. 33120. I need to deduct 33120 from the book value. Selling price is just 4,500. On the top of it, 10% selling commission is also there. So 4,500 minus 10% is 4050. This is the realizable value. 4050 into 6 is 24,300. So here I should add 24,300. So my dear friend, your inventory book value is 12,50,000. 9 lakh currently you are not considering. You have taken a sample of 3,50,000. This sample comprises 3 items A, B and C, which will be included at 1,15,000, 29750 and 24,300 in your books, and their book value should be deducted from the total book value of sample. So 3,50,000 minus 70,000 minus 50,000 and minus 33,120. So now this item has a book value of 196,880. The book value of remaining items. Book value of remaining items is 196,880. And realizable value of this 196,880 is less than the cost by rupees 29,532. So 196,880 is the cost, minus you need to do 29,532. So you just do minus 29,532. This is 167,348. So this book value should be included at a realizable value of 167,348. 167,348. Okay. So now you have 2 items. I'll just highlight it. This is one item at realizable value of item ABC, and this is realizable value of remaining item from your sample. Now the question arises, what is the realizable value of this 9 lakh rupees? For that, the question has given us a guide that this percentage downfall should be applied to 9 lakh also. So 196,880 was book value and downfall is 29,532. So 29,532 29,532 divided by 196,880. 196,880 is the book value of remaining items after deducting special items. Book value of remaining item. And on that, there is a loss of 29,532. So this is 0.15. That is 15%. Okay. So except special items, your sample has reduced by 15%. Therefore, the whole population should be reduced by 15%. So here I should deduct, here I should actually deduct 15% minus 15%. So 900,123 minus 15%. 1,35,000 is to be deducted. You'll be left with 7,65,000. You'll be left with 7,65,000. So this is the whole story now. You're making valuation of inventory. Book value of inventory is 12,50,000, out of which you take out a sample of 3,50,000. This sample has three special items A, B, and C. Book value of those special items is 70,000, 50,000, 33,000, 120. So book value of remaining sample items is 196,880, which is reduced by 29,532. So the realizable value of sample items other than special items is 167,348. Now, as far as special items are concerned, their realizable values are respectively 1,15,000, 29,750, and 24,300. Now, rest of the inventory, if this is reduced by 15% in general, this should also be reduced by 15%. So, in this three parts, when you make sum of these three parts highlighted yellow, you will finally get valuation of inventory. Okay. So taking into consideration only the above mentioned items required special treatment. Compute the value of their inventory as on, this line is useless. Compute the value of their inventory as at 31st March 2016. You would consider reasonable. So orally I have solved the entire question, and now I am going to solve it here step by step. Book value of selected items is given. From the given information, realizable value of remaining selected items will have to be found. Then the value of inventory for all items to be included in the financial statement is to be determined. So working showing realizable value of selected items. Selected items means sampled items. Book value of sampled items is 3,50,000. Out of which book value of special items A is 70,000, special item B is 50,000, special item C has a book value of 33,120. So book value of special items within the sample are 153,120. Where you deduct it from the sample, you get sample of general items. So sample book value of general items, that is not the special item, is 196,880. On this 196,880, there is a downfall of 29,532. So 29,532 should be deducted from 196,880, which comes as 167,348, and this downfall is actually 15%. So now finally, how to make valuation of inventory. Total inventory 1250, sample 350. So non-sample items are 9 lakh. Non-sample items are reduced by 15%, which is calculated in the above paragraph. This is 15%, which comes to 7,65,000. Then if I talk about special item, first special item A has a realizable value of 115. Special item B has a realizable value of 29,750, which is actually less than its cost. See, all three special items, have you noticed that their realizable value is less than the cost? Notice this. This was having a cost of 130, I think, realizable value 115. This was having a cost of 50, realizable value 29750. This was having a cost of some 33,000, realizable value 24,300. Total realizable value of special item 169050. Now, items other than special items in our sample are having a value of 167348. How come 167348? This is simply 196880 minus 29532. So value of all items of inventory as on 31st March 2016 is 11 lakh 1398. That is 765 plus 169 plus 167 added together will become 11 lakh 1398. So yeah, though it's simple, but it's a different question. Cost or realizable value, whichever is less. Okay. This was valuation of inventory for the purpose of accounting. Now let's do valuation of investments again for the purpose of accounting. The speciality of this illustration is how to handle the cum dividend scenario. Do you know what is this cum dividend? This cum is the short form for cumulative. So when I say cum dividend, it means cumulative of dividend. What is this concept of cumulative of dividend? See, this is a very simple concept. Suppose the company gives dividend every year on 31st March. Imaginary situation. I'm not talking about illustration aid. I'm creating my own example. Suppose the company pays dividend every year on 31st of March. I bought this share on 1st of April and I hold it for the whole year from 1st of April till 31st of March. But just 2-3 days before the dividend date, or maybe 5 days before the dividend date, say on 26th of March, you come to me and say, hey Tarun, would you like to sell this share? I say, look, I have been holding it for almost whole year. And after 5 days, this hen is going to deliver egg. This cow is going to deliver calf. This cow is going to produce milk. This share is going to give dividend. I have been waiting for almost whole year so that I can receive dividend. Now, when dividend is about to be paid and declared, you are asking me to sell the share. No, wait for 5 more days. And once I get dividend, I'll sell out the share to you. Because if I sell it out now, you will become entitled to dividend, which is absolutely wrong. I have been waiting for this dividend. You say, look, Tarun, don't worry. That this share has the price of 500 rupees and dividend expected is 10 rupees. So you sell me this share for 510. Either we can enter into an agreement that you buy the share for 500 and later once you receive the dividend, you refund it to me. But how can I believe you? You may not refund that dividend to me. So I'll say, okay, you give it to me now. Share worth rupees 500, I'm selling to you for 510. It means 500 I'm charging for the share and 10 rupees I am taking dividend from you in advance. After 5-6 days, you will receive 10 rupees dividend from the company. So from your point of view, you paid 510, which is the cum dividend price. Then you got 10 rupees of dividend. That should not be shown as income. That should be deducted from cost of acquisition. 510 is the cum dividend acquisition price minus 10 rupees dividend received. So your cost of purchase, cost of acquisition becomes 500. Now look at me. I received 510 and sold this share. But I won't say that my sale proceed is 510. I'll say my sale proceed is 500 and 10 rupees is for the dividend I have received. This is the concept of cumulative of dividend price. In short, people call it cum dividend. But if I don't sell the share now, wait for 31st of March, receive the dividend, and then on 1st of April, I sell you the share, it will become ex dividend, excluding dividend, ex dividend. Okay, Navratna Limited furnishes the following particulars about their investment in the shares of CMA Limited. Investor company is Navratna Limited. They have bought shares of CMA Limited. So we have to do valuation of shares of CMA. And this is not the fair value method. This is not the market method, market approach. This is the cost approach. That what is your cost of acquisition should be, the investment should be valued at cost. So balance sheet, balance of shares held on 1st April 2015. Initially, you were having 10,000 shares, having face value of rupees 10 each, and book value of 2,62,000, that is 26.2 rupees, 26.2 rupees per share. April, then May, June, July. After 3 months, you bought 2,000 shares in the company at 60,000 rupees. That is 30 rupees per share. But they are saying that this purchase price is inclusive of dividend. Okay, so while valuing the share, I will have to exclude dividend. I'll have to deduct dividend from 60,000. Then after 1 month, that is in August, you sold 500 shares at rupees 35 per share. And this 35 rupees is also inclusive of dividend. So again, I need to deduct dividend from 35 rupees. Whether I buy it or I sell it, if it is at cum dividend price, I need to deduct dividend. But as far as brokerage is concerned now, when I buy the share, I add it to the cost. And when I sell the share, I deduct it from my sale proceed. See, when I buy the share, I pay for the share as well as I pay for the brokerage. Pay for share, pay for brokerage, add it together. When I sell the share, I receive the money and I pay the brokerage. Receive, pay. That's why it is net. We do net of it, deduct it. In your study material, it is printed as Navratna Limited, which is absolutely wrong. It should have been printed as CMA Limited. CMA Limited declared final dividend for year 2014-15 on 1st of September 2015. And the rate of dividend is 20%. Do you know the formula for dividend rate? There is a difference between dividend rate and dividend yield. Dividend rate is dividend per share divided by face value. So when I say dividend rate, means it is expressed as the percentage of face value. Here the face value is rupees 10 and dividend rate is 20%. It means dividend amount is rupees 2 per share. On the other hand, dividend yield is dividend per share divided by market price per share. Dividend per share divided by market price per share, So that is dividend yield. Here this is not dividend yield, here this is dividend rate. Okay, 2 rupees per share is dividend. Also, you receive bonus of 1:5. Whenever this kind of ratio is given, whether for bonus or for split of share or for consolidation of share or for right issue, if they say 1:5, I mean, if they say A is to B is existing and A is proposed. If the ratio is given as A is to B, whether for bonus or for right or for split of share or for consolidation of share or for the purpose of merger, whenever A is to B ratio is given, B always indicate B always indicates your existing position. A indicates your proposed position. So 1:5 means if you are holding 5 shares in the company, you'll get 1 share as bonus. Fine. So you were having 10,000 shares, then you bought 2,000 shares, total 12,000 shares, out of which you sold 500 shares. So finally, on 1st September, you were having 11,500 shares. 11,500 should be divided by 5. 2,300 shares you will receive as bonus, and you don't pay anything for bonus. It's free of cost. Brokerage for each transaction is 2%. Now, brokerage is paid on the purchase price, which is 60,000, and on the sale price, which is 17,500. Find out cost of share held by Navratna Limited as at 31st March 2016. Fine, we'll do it. So this is your statement of cost. This is valuation on cost basis, not on market value basis, not on fair value basis. Opening balance 10,000 share at 2,62,000, 2,62,000, right? Then you purchase 2,000 share inclusive of dividend at 60,000 rupees, and brokerage is 2%. So 60,000 into 2%. Here, say this is 60,000 into 2% is 1,200 rupees. This should be added. So your cost of purchase becomes 61,200. Now dividend, 2,000 shares multiplied by rupees 2 per share. 20%, that is 2 rupees. 2,000 share into 2 rupees per share. You have paid 60,000, but out of that 4,000 you have paid for dividend. So your true cost is 56. Okay, so 61,200 minus 4,000 paid for dividend. Your actual cost of acquisition is 57,200. It should be added to 2,62,000. Now on 1st of August, you sold 500 shares inclusive of dividend. Sale proceed given in the question is 17,500. Brokerage 2%. So this is 17,500 into 2%. 350. Yeah. Deducted. Net sale proceed is 17,150. Less the dividend paid. This is cumulative of dividend. So you need to deduct dividend. 1,000. How come 1,000? It's 500 share multiplied by 2. Now see, your sale proceed, net sale proceeds is 16,150. But you don't deduct here sale proceed, right? You need to deduct cost of sale. Cost of sale, either you can take on FIFO or you can take on weighted average. Let's take it on weighted average. So it's 2,62,000 plus 57,200. 2,62,000 plus 57,200. 3,19,200 divided by 12,000 shares. 26.6 rupees multiplied by 500 shares sold. 13,300. See, 3,19,200 divided by 12,000, 26.6. multiplied by 500, 13,300. The difference amount 16150 minus 13,300. Profit is 2850. Currently, we are not calculating profit. Currently, we are calculating cost of remaining investment. So it should be deducted at 13,300 because that's the cost of sale. Now, bonus share, I told you it's 2,300 shares. Cost of acquisition is nil. For right shares, cost won't be nil, but for bonus, it is nil. Total cost of investment is 3,05,000. And now your number of shares are 11,500 plus 2,300, that is 13,800. So 305900 divided by 13,800, it's 22.17. $22.17 per share. Okay. Now let's talk about our income also. How much dividend do you receive? So on the date of dividend, you were holding 11,500 shares. 2 rupees per share is the dividend. So 11,500 into 2. Dividend date is 1st September. And on that date, you were having 11,500 shares. So you received 23,000 dividend. But entire 23,000 is not your income. You received 23,000 rupees dividend, but out of this 4,000 you have already paid while buying the share. So that 4,000 is not your income, that is deducted from your cost of purchase. So actually though you received 23,000, but out of that 4,000 you have already paid, so your net dividend income is just 19,000. But on the other hand, by selling the share, you received extra sale proceed. That extra sale proceed is not sale proceed, that is actually dividend. So on 500 shares, you receive 1,000 rupees dividend in the form of sale proceed of share. So your actual dividend income is 20,000. Right? This can be very easily reconciled. Originally, you were holding 10,000 shares. 10,000 shares into 2 rupees per share is 20,000. Very simple. Then you bought something, you sold something. You don't deserve that dividend. No? You deserve dividend for which you are holding share originally. So 10,000 share into 2 rupees per share is 20,000. Now, profit on sale of investment. So I told you that your sale proceed net of brokerage is 17,150 less dividend was 1,000. So it was 16,150. Look here, it was 16,150 minus 13,300. Profit is 2850. Dividend income 20,000. Profit on sale of investment 2850. These two items will find place in profit and loss. And in the balance sheet, the value shown will be 3,05,900. Right? So this is a whole investment accounting, investment valuation for the purpose of right? We have done valuation of inventory, valuation of investments. Now let's talk something simple. Present value of growth opportunity. What is the concept of PVGO? It's a very simple concept. As simple as that. Suppose a company's earning is expected to rise at the rate of 10% per annum. Considering that fair value per share is rupees 200. If there is a growth of 10% in the earning and dividend of the company, then its current price should be 200. But if the earning and dividend of the company becomes stagnant, then its fair value should be 80 rupees. What does it mean? This extra 120 rupees is due to the fact that company is expected to grow at the rate of 10%. This is called present value of growth opportunity. So it's very simple. You make valuation with growth, then you make valuation without growth, and calculate the difference. Illustration 12. ABC company forecast to pay rupees 5. It's not 500. It's 5 rupees dividend next year. Okay. This is not D0. This is D1. In Gordon's model, we need D1 only. Gordon's model? Yeah. For growth, for a growing perpetuity, we use Gordon's model, which represent 100% of its earning. Oh. If 100% of the earning is distributed as dividend, then there is no growth, my dear friends. Growth is only there if you retain something, because growth formula is return on equity multiplied by retention ratio. If payout ratio is 100%, retention ratio is 0. If retention is 0, growth is 0. This will provide investor with 12% expected return. It means the cost of equity is actually 12%. So in this case, the formula is very simple. I must say this is equal to D divided by K. It's 5 rupees divided by 12%. Value of this share should be 41.67 if there is no growth. Instead, we decide to plow back 40%. Plow back means retain and reinvest. Plow back means retain and reinvest. It simply means retention ratio is 40%. And ROE, return on equity, is 20%. Firm's current return on equity is 20%. So growth rate is simply 8% now. Look here. The growth rate is 8%. Now, dividend for the next year won't be 5 rupees. It will reduce to 3 rupees. Yeah, 40% you are retaining. It means that 60% you are paying out. So 5 rupees into 60% is 3 rupees. And you already know the formula for Gordon's model. It is D1 upon KE minus G. So KE is 12%, G is 8%, 3 divided by 0.04 is rupees 75. So initially it looks like that if you pay dividend, if you retain some amount, your dividend reduces, and if dividend reduces, price should reduce. But in fact, price is not reducing, it is rising because there is a growth opportunity. I'll tell you one very simple funda over here. Nobody will tell you this. If your return on equity is more than your cost of equity, which is the case here, return on equity is 20% and cost of equity is just 12.5%. In this case, the best dividend policy is to give lowest dividend. Why is it so, sir? See, PVGO, okay, is very simple. Okay, just a minute. Allow me to hold this. So, look here, the present value of growth opportunity is very simple. Price with dividend is 75. Price without dividend is 41.67. So, present value of growth opportunity is 33.33. That's fantastic. Okay, we have solved the question. But now, Let's talk something very special, something new. Best dividend policy. If return on equity is more than cost of equity now, believe me, the best dividend policy is to give lowest possible dividend. The lowest possible dividend can be zero, right? Here, look here, look. If I give zero dividend now, if I give zero dividend, what happens? Or not, let's not make it zero, let's make it very minimum, because if I make it zero, calculation won't be feasible. Give lowest dividend. So let's say dividend is just 5% of your income. So 5 rupees, or say just 1%, 5 rupees into 1%, that is 5 paisa. Okay, I'll give dividend of 5 paisa. In fact, sorry. Again, the calculation won't be feasible. Allow me to think about a feasible calculation, or I'll have to create a new example. In fact, just a minute. Okay, let's reduce the dividend further to 20 into 60. Yeah, 40%. Let's pay out only 40% dividend. Here we are paying out 60% dividend. No? So let's pay out 40% dividend, which will be 2 rupees. In that case, the retention ratio will be 60%. And 0.2 into 0.6, this will become 12%. Oh, okay. This is not a good example. To prove my point, I'll have to first create a good example. All right. Just give me 1 minute. I'll create one very good example for you. First, let me finish this. If ROE is less than KE, then you should give highest dividend. If ROE is equal to KE, price will remain unaffected. Whatever is your dividend, price will not be affected. So let's create one example, because this was not a very good example to explain my point. Suppose your EPS for the first year will be rupees 10. Suppose the cost of equity is 20%. Suppose return on equity is 18%. Now, return on equity here in this example, or let me change this to 18% and this one to 20%. So look here, return on equity here in this example is more than the cost of equity. So if I change the dividend, how will my price per share change? Look here, P0 is equal to D1 divided by KE minus G. So let's take some scenario. If I give 100% dividend, 100% payout ratio, then D1 will be 5 rupees. Cost of equity is 18%, and growth rate will become 0%. I'm giving 100% payout, so growth will be 0, and this will become 5 divided by 18%, 27.78. Right? So this is the situation when 100% payout ratio is there. Okay? Now, if I reduce the payout ratio, here the policy should be to give lowest dividend. If I reduce this payout ratio to 50%, in that case, dividend will become, I'm sorry, it was 10 rupees. I'm really sorry for that. If it is 10 rupees, so 10 divided by 18% is 55.56. Now, if I give only 50% dividend and 50% I retain, this will become 5 rupees. And the growth rate here will be return on equity into retention ratio. Return on equity is 20%. Retention now is 50%. So growth rate will become 10%. So 5 divided by 8%. 5 divided by 8%. See, it has gone up to 62.5. Moral of the story, if you reduce the dividend, market price increases due to present value of growth opportunities. If I reduce it, further, say to, just a minute, 20%. In that case, 20% means 2 rupees and 80% will be retained. So 20% into 80% retention ratio will give me 16%. Now 2 rupees divided by 2%, this will give you 100 rupees, right? Now you can say, okay, sir, just give 5% dividend or give 0% dividend. In those situations, formula will fail. So we need to take care of feasibility of formula also. Even if you say Meena that give 10% dividend, in that case also formula will fail. Because 10% dividend on 10 rupees will be just 1 rupee. And here this will become 19%. Because if I am paying out 10%, I am retaining 90%. So 20% into 90% will be 20 into 90 will be 18%. Growth rate will become 18% and price will actually become infinite. That's the problem, that if you reduce the dividend to 10%, it means retention is 90%, so growth rate will become 18, and if cost of equity and growth rate becomes equal, it will be 1 divided by 0, which is infinite. Lowest dividend will give you infinite price. Now that's not practical life. So in practical life, I'm not saying give 0 dividend, I'm saying give lowest possible dividend where the formula actually works. Okay, my dear friends. So if ROE is more than K, it simply indicates that you are earning more than the expectation of your investors. Your expectation of investor is 18, you are earning 20. So what investors will say, oh buddy, you hold this money because if you give it to us, we will earn only 10%. If you keep it, you will earn 20%. You are earning more than what we expect. So better you keep this money and don't give it to us in the dividend. Okay. So this is how the present value of growth opportunity and rises. 100% means no growth. Here no growth was there. So the price was 55.56. Here growth was there. So price has gone up to 100 rupees. The difference is PVGO, present value of growth opportunity. This is something fantastic. You can keep in mind at least this point. You can create an example yourself and try to prove. Okay. See you in the next session. Till then, thank you. Bye-bye.